I do want to go to Harry Hutchinson because, Harry, we're getting new numbers on inflation. Inflation rose just 0.2% in June. That was less than expected. Consumers have gotten a little bit of a break from some price increases, though food is still up and some items are still up. But so what do we read from these numbers? We're all trying to figure out again, are we getting out of a recession? Are they going to stop raising our interest rates because of that? Could they even start lowering our interest rates because of this? How does this really impact an everyday American?
First, the bottom line, I think, is we should expect the Fed to resume its policy of raising interest rates within the next 3 to 6 months. Why is that? Because core inflation, which is quite different sometimes from what is reported, continues to rise at a fairly rapid annual rate, even though on a monthly basis it's come down a bit. What makes up core inflation? Things like food and shelter. Shelter includes mortgages, rent, and the interest payments we make when we purchase a house. And I think everyone knows that interest rates remain stubbornly high, and they're forecasted to continue to remain high. And as long as interest rates remain high, for average customers, this is going to be an impediment to purchasing a house, but also it's going to help drive up rental rates for individuals who are not purchasing a house. So I expect that within the next 6 months, the Fed will continue to raise interest rates, and that will indeed be a drag on the overall economy. And I think it's going to be difficult to forecast that we are going to get out of the situation that we are currently in. I think consumers will limp along. Some months will show some progress. I think energy prices have come down. Right. Gas prices have come down. So those are some positive developments. And I think basically we should forecast that the consumer will tread water over the next 6 months to 12 months.
Yeah, and those consumers that are looking to maybe get a mortgage or something where interest rates really affect that decision, you don't think they're getting any relief anytime soon?
No, I don't. And the other problem, of course, is some people have seen the size of their family rise and they would like to buy a house, but there are no buyers in certain markets. Now, certain markets are still doing really well. Some of the high growth markets in the South, including parts of Tennessee, Texas, and parts of Florida are doing well. But if we are looking at the economy as a whole, right, I think we're treading water.
I mean, you name all those states, those are all states with one thing in common: no state income tax. So it kind of can balance out a little bit of that interest rate situation where if you're trying to get out of a high tax state or a city that's failing or a state that's failing with crime and all these other issues, but you're going to get it to a no tax state, maybe it balances out a little bit better for you and you're in a somewhat better position if you're able to move into one of these no state income tax states, even though you wouldn't be getting the full benefit because interest rates are still so high. So people that are locked into good low interest rates, are not selling their homes unless they absolutely have to. And I think that's really the line for most Americans of this. It's not the random numbers that get reported out each month, Harry. It's when will this get to a point where I can take a loan out and not pay 8%?
I think you're precisely correct. So if you look at the real estate pages throughout the United States, occasionally you'll come across a house where the existing mortgage rate is below 3% and it's assumable. That is a fantastic deal right now. I saw one recently, 2.8%, and it was assumable. Yep. But nonetheless, that particular house took almost 4 months to sell in this market, and it has an assumable mortgage associated with it.
People just are still hurting. And again, the clarity out of the White House is just very weak.